Welcome back to my channel. Hi everyone. Today we're talking about one of the most important questions of 2026. Where should you invest your money this year, especially if you're a beginner who wants safety, growth, and long-term stability? The world of investing has changed a lot over the past 2 years. Inflation cycles have slowed down, technology is expanding faster than ever, and global markets are moving in completely new directions. So in this video, I'm going to guide you through the smartest, safest, and most realistic investment opportunities you can make in 2026, without needing advanced knowledge or a huge starting budget. First, let's talk about the reality of 2026. This year is all about balancing risk and stability. Investors no longer chase hype, they chase fundamentals. That means your money needs to go where value is actually being created, not where trends on social media say it is. So the first category every beginner should look at is index funds. Index funds remain the most consistent and low-risk investment in 2026. They track the overall market, they spread your risk across hundreds of companies, and they have historically outperformed most individual investors who try to pick stocks. For beginners, index funds like S&P 500, global equity funds, or tech-weighted indexes are some of the smartest moves you can make this year. They give you stability, long-term growth, and protection against short-term volatility. Next, let's look at technology sectors because 2026 is shaping up to be a massive year for AI, robotics, automation, biotech, and renewable energy. But the key is not to buy random tech stocks. You need to focus on companies with strong revenue, real adoption, and proven growth. Artificial intelligence has matured, robotics is moving into mainstream industries, and biotechs working in gene editing and personalized medicine are becoming extremely valuable. Investing in diversified tech ETFs gives you exposure to this growth without the risk of choosing a single company. This is one of the safest ways to benefit from upcoming technological waves. Now let's move to something more defensive: government bonds and high-yield savings accounts. In 2026, interest rates are more predictable, which makes bonds a solid option for beginners who want safety and steady returns. They may not make you rich quickly, but they protect your capital and provide guaranteed income. If you're the type of investor who wants stability, this category is essential to include in your portfolio. A balanced strategy usually means having both growth assets like tech and stable assets like bonds. Real estate in 2026 is an interesting situation. Traditional property buying is more expensive than ever in many countries, but REITs, real estate investment trusts, continue to give beginners an easy way to invest in property without needing a huge budget. REITs pay consistent dividends, and you can start with very small amounts. They allow you to benefit from commercial real estate, data centers, rental housing, and even storage facilities, all without owning a building yourself. This is one of the most practical and beginner-friendly investment paths this year. And finally, let's touch on digital assets. Crypto in 2026 is no longer the Wild West it used to be, but it's still higher risk compared to traditional markets. If you're a beginner, crypto should be no more than 5 to 10% of your portfolio. Focus on major, stable projects rather than speculative tokens. Treat crypto as a long-term bet, not a guaranteed income source. Diversify, secure your assets, and avoid hype cycles.
So, where should you invest your money in 2026? The smartest strategy is a balanced one. Put part of your money in index funds for long-term growth, part in tech ETFs for future opportunities, part in bonds for stability, part in REITs for passive income, and only a small portion into crypto if you want exposure to digital assets. Investing in 2026 is not about taking big risks. It's about making smart, stable, educated decisions that grow your money over time. Thanks for watching, and I'll see you in the next video.